With the craziness of interest rates and people are going, man, I just can't afford that much right now. There are a lot of people asking questions about assumable loans. What the crap is that? How does that work? That's a great question. We're going to talk a little bit about that today. What's up, guys? Mark Cannonre, your local realtor here in the Phoenix area. If you find value in these videos, like the video, share with your friends, trying to be a resource for people, trying to help them understand the world of real estate so that way they can move forward with their dreams. Okay, so we're going to talk through assumable loans. The first thing we'll do is we'll talk about what an assumable loan is and what that looks like. And then I'll give you a scenario so that way you can see what an actual scenario of assumable loan would look like. So let's start with what it is. So assumable loan is where it's a loan that you can take over. And why would you want to do that? The reason you want to do that is because let's say someone has like a 3.25% interest rate. All of us would want that, right? Because interest rates are at 7, so it's more than double. You would love to have a 3.25% interest rate. So the loans that you can do that with is like a veterans loan, so a VA loan, or an FHA loan. So government-backed loans are the ones that you typically can take over. Now, one side note, I will do a video about this next week. So check this out. But for veterans, you got to be careful because if you let someone assume your loan, you can't go use your VA loan to get another house. They assume it. There's a lot of logistics with it. I'll do a video on that next week, but always want veterans to be careful with that. So when we're talking about assuming a loan like that, what does it really look like? Well, that's what we're going to check out here. Okay, so we're going to talk through this scenario, and then I'll give you a couple things at the end to really think about and things that might be able to apply to you. So I'm going to put it up over here so that you guys can see it. I'm going to look at it just to make sure we get it right. So we're going to say somebody bought a home for $400,000. I'm going to use whole numbers because it's easier. I'm going to say somebody bought a home for $400,000 in 2021, right? In August 2021. They put 5% down. So $20,000 down is an FHA loan. Okay, great. The mortgage is $380,000. Okay, so their interest rate is 3.25%, which we all want. We all would love to have that right now. All right, so now it's 2024, right? It's 2024. The house is now worth $450,000. So it's worth $50,000 more than what they paid for it. Okay. They have the mortgage down to $370,000. So they've paid about $10,000 off of principal. And again, I'm just using round numbers. That number could vary, right? But the difference in value is $80,000. Okay, so why is that important? So with an assumable loan, when you're assuming a loan, the mortgage is $370,000. But the value is $450,000. So in order to assume a loan, you have to bridge the gap, right? That's why appraisal value is important. So you're bridging the gap of that loan. So everybody's like, well, I don't have $80,000 sitting around. And that's the thing is, I get it. A lot of people don't. They don't have that kind of cash sitting around. Some people do, and they're able to assume the loans because they have that much to be able to spread the gap and assume the loan. And that's great. The other people that are typically doing it, outside the people who have the cash, is people who are selling their house. And let's say they made $100,000 on their house. Well, they can assume somebody's loan because they can cover the gap. Okay, so you have to think of the gap as like a down payment. So you're really putting the down payment down to then assume that loan. So instead of getting a 7% mortgage, you're now getting 3.25%. That's phenomenal. And that's why it's becoming a thing right now that people really want to do assumable loans. Because they want to say, okay, yeah, I'll put that down payment down because it doesn't change the home's value. All it does is say, hey, you put this large down payment down, now you can assume this loan at this interest rate. That's the thing that everybody wants. Now, the thing that, and I'll do videos on this in the future over the next couple weeks, there are now companies and even like lenders, even my lender that I typically use has a program for this where they'll actually do a home equity line of credit to cover the gaps. That way you can get that interest rate. And so everybody's scenario is different, right? And that's why it's important to talk to me or another great realtor if you're in a different state because, and why would you use anyone else in Phoenix? Obviously you use me. So, but no, like it's one of those that you want to talk with someone who has those answers, who can make that work if it can work for you. It may not work for everybody. Like if you're not selling a home or you don't have that cash, it may not work for you. Now, maybe those programs with the HELOCs, it might work, but that's on a case-by-case scenario because it's not going to necessarily work for everybody. So if you want more information about this or you want to talk about this and strategize on this, or maybe you know someone that could use this information, I would love to talk with them. My information's below. I hope you'll reach out to me or share that person's info if you're thinking of somebody. Guys, you've been listening to The Real.